It has been a bit of a wild ride in the economy for the last couple of years. Relatively high inflation right now. Many people are worried that this is the 1970s and that this inflation is going to get worse or even just continue. I want to discuss that today. My name is Elliott Parker. I'm professor of economics at the University of Nevada, Reno, and I'm chair of the Department of Economics. The U.S. economy grew by 5.5% if we measure it in terms of real GDP per capita. This is the fastest growth rate we've seen since 1984. But it's only 1.6% above where it was 2 years ago. That is, this fast recovery was to some extent coming back off the deep recession we had as a result of the pandemic. And the economy in the last several years has been growing at an average rate of about 1.7% per year, again in per capita terms. That means that we're still a little bit behind where we could have been if we'd not had the pandemic, and there's room to grow. Real consumption spending, however, grew by 7.7% in 2021, and that's the fastest growth rate we've seen in consumption since 1946, when we were coming off of World War II. This right now is significantly above recent trends, and that has been leading to some overheating in the economy. Here's a picture of consumer price inflation going back to 1970. I want to just reassure you that the inflation we're seeing right now is not exactly the same as the 1970s, and we don't really have a strong reason to think it's going to continue at this rate. So zooming in on the inflation over the last 7 years, you can see the month-by-month variation. Last month's inflation rate, for example, for the Consumer Price Index was actually relatively low, but the previous month it was high, and on average, we're looking at inflation right now in the 8% range, and the question is whether that's going to continue. You can find in the media a lot of people trying to blame the president, that the president is responsible, as this headline says. But as H.L. Mencken once said, for every complex problem, there is an answer that is clear, simple, and wrong. And it is wrong to say that the president has done anything to cause the inflation. It's much more complicated than that, and I'm going to try to explain that. So the first question is it possible to make inflation simple? I'm an economist, and of course we do our best to make simple things complicated, so doing the reverse can sometimes be a challenge. Because what we want to do is try to make it simple and clear without being wrong. We want to know, will inflation continue or will it end soon? And then we want to look at what caused it. Was it corporate opportunism, as some people are arguing? Is it due to supply chain bottlenecks? Is it due to a tight labor market? Is it caused by excess government spending? Or is it simply that the economy currently has too much money circulating in it? Basic economic theory says that monopolies will charge higher prices. And so if there's less competition, you should see higher prices. But that doesn't necessarily mean that the rate of price inflation would be higher, right? Prices may be higher, but they would stay higher and not necessarily rise faster. Now, there is also anecdotal evidence of certain firms exhibiting opportunistic behavior. They want to raise prices, but they don't want to deal with the PR fallout. And it should be no surprise to anybody who understands how market economies work in the American version of capitalism. Firms want to maximize profits. So what does the evidence tell us? The evidence tells us that while there are stories we can tell about those anecdotes, overall, statistically, it's not so clear. Some people have found that concentrated industries do have more price stability rather than price instability. Some have found that concentration is correlated with inflation persistence, and some studies have found no correlation whatsoever. So even if it's true that there's opportunism by large companies who want to increase prices during an inflation, this is still more of an effective inflation than the cause of inflation. That is, it may be making inflation a little bit worse, but it's not the underlying cause of why prices are rising in the first place. There is an exception. That is, if you have a small number of firms providing a product, then if something happens, that product may become unavailable and create higher prices and loss of certain products. I'm sure you're familiar with what's going on right now in the baby formula market. So what are the issues related to supply chain bottlenecks. I think one way to think about it is our economy is globally integrated. We're connected with the rest of the world, and many products have a very complex supply chain. And firms, which are trying to maximize profits, even if they're small and competitive, but especially if they're very large and not competitive, they want to maximize short-run profits in order to better pay their shareholders. But managers often lack the incentives to focus on the long term or plan for shocks. Just-in-time inventory management means basically that firms are not going to hold big warehouses full of product. They're going to try to get it just when they need it, and that works great as long as everything goes right. But the pandemic was a huge shock to the economy. It disrupted production, it disrupted transportation, it led to big changes in demand. Now, mostly when it happened, people stopped buying a lot of things, but some things they started buying a lot more of. For example, the toilet paper shortage that we faced about 2 years ago. Many firms don't find it profitable to make big changes for temporary events. Inflation is concentrated in just a few sectors. The biggest one, of course, is the energy sector. We've seen rising prices of oil. That's led to rising prices of gas, electricity, everything else. Food prices have gone up 9.4% in the last 12 months in the United States. Used cars and trucks went up almost 23% in price over the last 12 months, but new vehicles are also a lot more expensive. And there's a variety of other products where prices have gone up, but for the most part, other sectors of the economy have not seen inflation quite as high as in the sectors of energy, food, and vehicles. The pandemic hit world oil supply, demand plummeted, inventories rose, and what we saw worldwide was a huge drop in production. It's not that easy to shut down oil wells or to turn them back on, and there hasn't been a lot of investment in new facilities. But if you look at this graph, what you see is the production of the 5 biggest oil producers in the world: the US, Saudi Arabia, Russia, Canada, and China, followed by other countries in the Middle East and North Africa. This includes most of the OPEC countries, Latin America, including Venezuela, Africa, including Nigeria, and all the other countries in the world, including, for example, Norway and the United Kingdom, that produce petroleum. What you see is that there was a big drop in U.S. production, but there was a much bigger drop in the rest of the world. So trying to focus on the behavior of U.S. oil corporations as the source of the world shortage of petroleum is missing the point. This was a global market. This was a global hit to demand that then affected supply. You can see in this graph, for example, what happened in 2020 versus 2021. In the U.S., which makes up about 20% of the world oil supply, we saw a 10% drop in production in petroleum in 2020, followed by a 9% recovery. So that meant that by January of 2022, we were still 2% below where we had been 2 years before. Now, the U.S. oil market is still bouncing back. We see Saudi Arabia didn't fall quite as much and bounced back a little bit more. Russia, of course, is still down, and this has something to do also with the invasion of Ukraine. Canada is still 4% below where they were 2 years ago. China is relatively flat. We see the big drops in Latin America and in Africa and the rest of the world. In fact, 74% of the entire decline between the end of 2019 and the end of 2021 has come outside the top 5 oil-producing countries. Meanwhile, demand has recovered. So what did this do to oil prices? Well, this is showing the U.S. oil price in black for a price of regular gasoline relative to the price of oil in the West Texas or Cushing market and the North Sea or the Brent market. Now, the first thing you should notice here is that the price of gasoline is highly correlated with the price of oil, and that the price of oil in the Cushing and the Brent market track each other very closely, with a brief exception between 2012 and 2014. What that tells you is that this is a global market, and what's happening in the rest of the world, North Sea, Ukraine, Europe, Nigeria, all the effects of the rest of the world affect the market in the United States. Now, looking at those prices but adjusting them for inflation, all of a sudden that $4 gasoline doesn't look quite as high as the price of gasoline we saw right before the Great Recession started back in 2008. But the point here, of course, is that world events are what's driving the price of oil. The invasion of Ukraine is a major factor in the recent jump up in oil prices and the fact that we expect it to remain relatively high for the next several months. That, of course, then affects the cost of transportation and everything else. The United States has relatively cheap gasoline compared to many developed countries in the rest of the world. In fact, some countries that aren't quite so developed. We have cheaper gasoline than Brazil and India and China, for example, but also Switzerland, the UK, France, Italy, New Zealand, Germany, etc. Now, while the US may have relatively low prices, Nevada and California have relatively high prices. That is, we have some of the highest priced gasoline in the United States, usually about $1 a gallon more. So the cost of transportation in part was also affected by the cost of containers used to ship goods across the ocean. You can see in this graph that the price of a container freight basically rose by a factor of 10. Now, part of the thing that affected this was that we had empty containers spread all over the world due to the distribution of masks that we were seeing back in 2020. So those masks were shipped from China to many places in the world that needed them, but goods weren't necessarily packed in those containers and sent back. But on top of it, you had a lot of people buying more goods internationally. And remember, this is a global market. This was not anything that was the decision of the President of the United States or had much to do with simply factors that were happening in the U.S. Food prices have gone through the roof for many of us, and I just went to the grocery store yesterday and, often surprised at how much it costs. But compared to the rest of the world, we see that U.S. food prices have been relatively stable. So the green line represents the consumer price index for food. The red line represents an index of global food prices. Now, why are global food prices so variable? Well, Brazil had a horrible harvest in 2021. China is currently having one. Ukraine has something like 20 million tons of grain that can't get to port right now because of the war. On top of this, we have labor shortages, including in the United States, immigrant labor that would normally be working to help plant and harvest in the Central Valley. There's an estimated 2 million fewer immigrant workers in the United States than there would have been under past trends. So planes, trains, and automobiles were all affected. Planes, for example, there was a 96% drop in the number of miles that passengers flew, and a recovery that has still not quite caught up anywhere near to where we used to be. Planes have been removed from services. For example, there were problems with the 737 MAX that led to some planes having to sit on the tarmac. Jet fuel is more expensive and it makes up 20% of the cost. And on top of that, there's a lot more air freight flying around the world. And that means that airlines have an incentive to reduce the number of seats and add more freight space. Trains, of course, not really a viable passenger option in the West. Really, you have to live on the East Coast to be able to use that. So trains are mostly being used to move freight and not people. And automobiles. There's something like 3,000 different chips, computer semiconductors that are used in a typical automobile nowadays. And a lot of them were being produced by the Taiwan Semiconductor Manufacturing Company. They ran into some glitches. They weren't able to keep up with high demand, and they found that the automobile market was not really their most profitable market. They made a lot more money trying to sell chips for iPhones and similar products. And of course, rental car markets were affected by the fact that many Rental car agencies started reducing their inventory. Used car markets have been affected by the fact that we're not producing as many new cars. So many people have moved to used cars and are paying prices that are almost comparable to what they bought the car for in the first place. Home prices, of course, have also gotten a lot more expensive. This is the Case-Shiller Home Price Index, and you can see that since the recovery from the Great Recession, there's been a dramatic increase in home prices. Interestingly enough, the number of homes we have in the United States has more or less caught back up to where it was right before the Great Recession relative to population. However, where those houses are located has not caught up to where people want to live. You could probably buy an entire block of houses in Detroit for the cost of a small home in Reno right now. Low interest rates has helped to fuel this. The fact that you've been able to get a cheap mortgage has led more people to want to enter the market, and that's pushed prices up. We have, of course, seen those prices rising dramatically. This is showing the Consumer Price Index first for all goods, that is, all urban areas, and this is the black line. The gold line represents the price of housing in the United States, and we see that especially between about 2012 and 2020, that inflation in housing was faster than inflation in the economy overall. The green line represents the price of rents for a primary home in the United States, and that's been rising faster than the price of housing itself. And finally, the price of rent in the West for a primary home has been rising even faster than that. But if you look at the last year, that is since 2021, you see the rising of prices overall has been much faster than the increase in prices for rents or housing itself. So basically, it's other things that are making inflation so high, not just rents. Our second explanation for inflation is a tight labor market. There was a big drop in employment relative to population, which you can see in this black line, and also a big rise in the overall U.S. unemployment rate. And that has mostly ended. We are back down to something like 3.5% in the United States, which is about as low as we've seen in my lifetime. And most economists would expect that when we get inflation under 4%, that this is going to start making it harder to produce many products. It's going to see rising wages and rising prices. Now, with a tight labor market, you would expect wages to be rising significantly. And we do see that wages have been rising since 1980. But what we're not seeing here is how those wage increases compare to price inflation. So looking at the wages for non-supervisory employees, we then see a big jump up during the pandemic in the average wage. But this is being driven by largely the fact that during the pandemic, people at the lower end of the income distribution were losing their jobs. And so the remaining workers are being paid more on average. And so as low-paid workers re-entered the workforce, we see those wages start coming back down to keep up with past trends. In thinking about that, then, we see that wages are not really what's driving the increase in prices right now, that wages have been actually coming down relative to inflation. And so it suggests that something else is pushing that inflation up, not wages. So one of those possibilities is the argument that we've had too much spending, and that's increase in spending has led to the increase in demand led to inflation. Yes, we had big government relief programs in 2020 and again in early 2021. And this, combined with the fact that in 2020 people were spending less on consumption, led to a big increase in savings. People couldn't spend the money they had, they were putting it into the bank, and then they started spending that money again in 2021 as the economy started to improve. But one point about this is to realize that inflation, if it's coming from spending, will be temporary because the spending itself was temporary. And you can see that besides these two peaks, that disposable personal income has been coming back down to where it should have been at trend. But note also in this graph another change. The blue line on the bottom shows you spending on services, whereas the purple line shows the spending on goods. Spending on services fell, and while it's recovered somewhat, has not quite caught up to where it was back before the pandemic. Spending on goods, however, not only fell dramatically during the first part of the pandemic, but it has recovered and grown faster and is ahead of where it was back before the pandemic. And that has had a big effect on the prices of certain goods. So the argument behind too much spending is also substantiated to some extent by this graph looking at the federal budget surplus or deficit. It's a surplus if it's above zero, it's a deficit if it's below zero. And this shows the month-to-month variation as well as the annual averages. I've adjusted for population and inflation. You can see that there's a big drop that happened as a result of the Bush tax cuts after 2001. You see also a really big drop that happened due to the Great Recession. You see again a decline that happened from the Trump tax cuts in 2017. And then finally you see that the pandemic led to budget deficits that were simply off the charts. That is, big drops in government surplus or big increases in government deficits. But that has mostly ended. You can see that the deficits are coming back down to where they were before the pandemic. And in fact, just this last month, we had a record month for budget surplus. So what about having just simply too much money in the economy? Not just spending, but the actual money itself. To start with, economists believe that we should have a little bit of inflation. Mostly 2 to 3% inflation seems to be optimal for the operations of the economy, makes it easier for the economy to adjust. But Milton Friedman said in 1970 that inflation is always and everywhere a monetary phenomenon in the sense that it is and can be produced only by a more rapid increase in the quantity of money than an output. Meaning if money is growing faster than the economy, we're going to see inflation, he argues. Now, economists, whether they're on the left side of the spectrum or the right side of the spectrum, tend to agree with this only if we add the words "in the long run." However, John Maynard Keynes in 1923 once wrote, "In the long run, we are all dead. Economists set themselves too easy, too useless a task if, in tempestuous seasons, they can only tell us that when the storm is long past, that the ocean is flat again." What we saw in 2020 was a big jump in the overall money supply. Compare that, the purple line, to the blue line. The blue line here is representing the amount of currency in circulation rather than simply money. Now, what's the difference? The difference is deposits. It's checking, it's savings accounts, it's even some relatively small certificates of deposit. We consider those things to be money too, and the big increase happened essentially in the spring of 2020 as people were putting money in the bank that they couldn't spend. And that increase in bank deposits was driven by consumers, not driven by the Federal Reserve and the federal government. It's important to understand that presidents don't actually control the money supply. The Federal Reserve System, our central bank, manages the money supply, but even the Federal Reserve can't control it on a day-to-day basis. They can have some influence over whether banks lend money or whether people are depositing, but they don't really control it very tightly. They do have a little more control over currency in circulation than in deposits. So this graph is showing the growth rates of those variables. Now compare that to the inflation that we've been looking at. And what we see is that during the time when the money supply was growing the fastest was also a time when prices were falling the fastest. Notice that the period of high money growth that happened in early 2020 happened at the same time that we saw price deflation. That is, we saw falling prices in early 2020. And it's taken a couple of years to start seeing a rise in inflation that may have resulted from this. So the link between money and prices is not immediate. During the Great Recession and during the pandemic, the Fed has set the federal funds rate uh, more or less to zero. And the Treasury bill rate, the 3-month T-bill secondary market rate, has more or less tracked the federal funds rate that banks can borrow from each other at. The prime loan rate, which banks charge their best customers, is very close to following the same behavior that we see in the federal funds rate. And finally, we see declining mortgage rates for homes, and this is one of the factors that's led to rising home prices, is these cheaper interest rates. But in the last year, we've seen that start to creep up. And so looking in a little bit closer over the last 7 years, we start to see that the mortgage rate has started to rise. We've started to see the Fed responding by increasing the federal funds rate. And so what we're seeing in a sense that the Fed is starting to pull away the punch bowl, so to speak, to try to calm the party down. There's some argument that they should have done this 6 months ago, that maybe they're a little bit behind the curve, but better late than never. The bigger danger, of course, is if they do it too much, they could push the economy into recession, and that is a concern of economists. So with interest rates rising, with inflation picking up, with growth slowing a little bit after the roaring speed of 2021, Wall Street and the media, of course, have responded in the most calm and objective way possible that they can. And we see, of course, that sometimes this verges on the border of mass hysteria. This is a picture of what's happened in the S&P 500 stocks adjusted for inflation since 2015. So there's a rising stock prices that happened in the post-pandemic period, and that we have lost some of the gains we saw in 2021. However, if you take the longer run view, you really shouldn't panic about this. The stock market does what the stock market does. So in the longer run view, in this case going back to 1980, even if we adjust for inflation, the increase in the stock market we've seen since the bottom of the Great Recession has been very dramatic. What drives the stock market? Well, it's expectations. It's falling interest rates, which we've seen. It's rising corporate earnings growth. Falling corporate tax rates had a big effect on increasing the value of stocks. And finally, speculation drives a lot of what's going on in the short term in the stock market. Lots and lots of speculation. So what worries economists? Right? Low inflation doesn't worry us. Actually, low inflation we think is a good thing. It makes it easier to adjust relative prices and wages. High inflation, however, is hard. It's hard for people with low incomes who are likely to spend more of their money on goods that are rising in price, and it also leads investors and others to make poor choices. But what worries economists about inflation is when it becomes embedded in economy, when everybody starts to expect that it's going to continue. And if that happens, then interest rates are going to start to rise, not fall. So once interest rates start to rise because inflation is expected, it's going to be much more painful to try to get that inflation out of the economy. That process of disinflation generally will cause rates to rise even more. That'll cause a recession, and that recession, to get rid of the inflation, will either have to be very deep or very long. Now, of course, it's much better than to deal with inflation when the economy is doing well than to deal with it when the economy is doing badly. It's easier to pay for expensive things when you have a job. Now, looking at the causes we've discussed, this idea of corporate opportunism, that's not new, and it's not really the root cause of this inflation. At most, it's an exacerbating factor. Supply chain bottlenecks and increased relief spending. These were temporary effects of the pandemic. We should not expect them to continue, and therefore we should not expect it to lead to continuing inflation. However, things like a war in Ukraine do have a big impact. Russia invading Ukraine has affected oil prices and certainly is going to have a big effect on world food prices. Tight labor markets can push wages and prices up, and it can be a lag effect. Inflation now may lead to rising wages in the next year or so, and that, of course, can have upward push on more prices. The money supply did increase significantly in 2020. which, if I may remind you, was before the election. But the Fed is starting to tighten up now. And so our main worry here is whether the Fed overreacts and pushes us back into recession, or whether they're able to pull the punch bowl far enough away that we stop dancing on the tables, but we don't all go home. So what does the future portend? Well, there's ways that economists have to try to measure inflationary expectations. So the Federal Reserve Bank of Cleveland looks at the difference between the prices of Treasury bills that adjust for inflation and Treasury bills that don't, and it tells you a lot about what investors think about inflation. So investors currently are expecting inflation over the next year would be about 2.6%, over the next 2 years about 2.1%, and then remain relatively stable after that. So investors are more or less thinking that inflation is going to come back down over the next year. Consumers, on the other hand, tend to have higher expectations. They're currently expecting 5.5% inflation over the next year. But if you go back and look at the data, whether on the smaller graph, which takes us all the way back to 1980, or especially over the last 20 years or so, what we see is that consumer sentiment, as measured by the University of Michigan, has tended to overestimate actual inflation. And so even though during peak inflation periods everybody's underestimating it, nonetheless, consumers tend to be more wrong about inflation in the future than investors are. Consumers think inflation will stay high. Investors don't. Investors have been more accurate. However, the lesson we can take away from this is let's stay calm. This is a temporary inflation. It should get better, assuming we don't have another war in Ukraine. Thank you.